Well, g'day there traders and friends, market participants and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you this very brief weekend market update, a very important, very pertinent market discussion applicable to where we are and where we may be going at the current juncture. What we've seen over the past 3 weeks, really since the beginning of February, is a very impressive, a very strong breakout to the upside, really a continuation off from a lot of the footwork we put in throughout 2016. What we've seen really over the past 4 trading sessions, again, is the continuation to the upside on the Dow Jones Industrial Average, the S&P 500. However, it hasn't really trickled through to the NASDAQ. And this is really going to be, I guess, the mantelpiece or the centerpiece, maybe, I guess, the narrative of this weekend update. As you can see on the Dow Jones Industrial Average, we closed up just shy of 200 points. A very healthy looking candlestick. Volume is still there. It is rather ordinary. We have to account, obviously, for Monday being a closed trading day. You can see on the S&P 500, not Apple, let me bring up the correct chart for you, that we have a very similar candlestick. We closed up 16 points on the weekly chart. Again, a very nice continuation to the upside. Volume is relatively healthy as well. It all is ticking and satisfying the criteria of a longer term continuation. And again, I want to articulate myself in a way which is going to be as precise and to the point as possible. I, for one, am not calling this a terminal market top. However, I am suggesting on a broad range of, I guess, market internals and technical signals, also a little bit of wisdom that I've accumulated over the years of trading the financial markets, that we really need to start separating again emotion, the tendency of greed for, I guess, the acceptance and, I guess, the expectance really of things to continue, rather than, of course, allowing our analytical and sort of rational, logical mind, or a component of our mind, to sit back and say that, look, things need to stop, they will stop, and what do we do? What is our game plan, our if-then scenario, if we start to see this market move sideways and or pull back in a controlled manner? Now, the first sort of inkling of that, really, again, as I continue with this discussion, is the difference between the Dow Jones Industrial Average, the S&P 500, and that of the NASDAQ. As you can see on my screen right here, this is the weekly candlestick. The first thing that should be registering for you is that this isn't a white candle, nor is it a long day candle. It's what we call a doji candlestick. Now, this is the first signal on the weekly chart that we have warning us of potentially a slowdown. What it's really showing us, or at least explaining to us in terms of sentiment, is that market participants, active market participants, are somewhat short-term confused on price. Now, what that means, if we start accumulating that in with the daily candlestick bars, is that there was some form of a discrepancy, or at least a pullback, between Wednesday and, of course, Friday's trading session. We started to see this outside day candlestick, but however, what I should say is that largely this signal in and of itself became defunct based on Friday's price action. What we're starting to do is we're blending the lower wick of Thursday's candle along with the daily intraday movements of Friday's trading session. On a whole, the criteria of this market is still solid. It's foundationally solid, and we're continuing to the upside. In fact, we're still ticking, of course, the criteria of higher highs and higher lows, and that is across the board, not only on the NASDAQ, but if I bring this out to the Dow Jones Industrial Average, you can see that if we go back in time, really towards the end of 2016, this market has really only known one direction, and that is up, 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 and up. What we do, however, and what we have done during this bullish phase, is that we've moved into resting types of periods. And what you can see on my screen right here is 2 in particular. We've got one towards the end of 2016, and one which really sort of transitioned us into the beginning of 2017 through December and January. What we haven't done in some time is seen any form of a controlled pullback, but we are still ticking the criteria again of those higher highs and higher lows. What I want to do for you right now is really just impart a little bit of wisdom from myself into the public forum. Whether you accept it or think about it or sort of sit on it, compose it, whatever or not, that's your decision. But again, this is coming from a good place, and I'm willing and prepared to share this with you. When we get into these extreme movements, when we get into these sort of manias, these sort of kindred spirits in many ways, types of moves, purely driven by emotion, again, in many ways, the fear of missing out or the greed of not, I guess, accumulating enough, whether in terms of profit or positions, whatever that may be for that individual, we'll get to a point where there's just simply no one else to jump on board with the move. And in many ways, it exhausts itself. That's really how the sort of game sort of evolves in the full cycle of trading and markets in and of themselves. We're at a particular point now where we're starting to see the initial candlesticks indicating a slowdown. It's expected. We've moved a long way. And really what we should be doing, the mindset at least of looking at these markets should be more on a defensive side, as in locking in those profits we've accumulated over the past number of weeks or months. And really, again, just looking at this defensively and thinking about the potential of that next slowdown, if not that controlled pullback. It doesn't matter, for instance, on the S&P 500, if you got in at 2,200, or whether you got in at 2284, or if you got in just above 2,300, or whether you're in right now at 2,355, what matters is what that position is showing you at the current juncture, at the current time. What you don't want to do is, again, find yourself in that emotional state, disconnected from reality. At a time and at a future time, we will see some form of a pullback. So really, I guess the narrative and the theme of this discussion is really about locking in profit, placing stops, tightening stops when you feel comfortable to do so. At the same time, it's sort of like a juggling or a balancing act. No one knows where this intermediate top will be. We know that it will eventually come. But what we don't want to do is also miss out on the potential and the probability, even the likelihood of this just continuing in its sort of mania, which we're currently in at the moment. So personally, me sharing this with you is that I'll be taking positions off again, more or less, at the open and next week if the market opens up relatively unchanged. But it's going to be a percentage. It's going to be a portion. It's not going to be the entirety. I may, for instance, take 20% of my SPYs, my diamonds, and my Q trades off the table up and around these highs and keep the remaining 80, 70% open, but have a hard stop at a lower level. Now that lower level and that hard stop, that's not to suggest or to sort of say that, look, the remaining 70 to 80% of positions will be closed out at this particular point. But what I'll do, and I'll have to assess this with the candlesticks, is just monitor the pullback, monitor the sideways move, monitor what we call consolidation, or at least the digestion of the gains which we have in many ways achieved and accomplished over the past number of months, but then potentially leg out of another percentage worthy at a lower price, of course being profitable still, but then having, of course, the discipline to keep, or at least have an allotment, a certain allotment open for when that trend continuation happens. What we're looking at right now is a market that is trending, it's healthy, and it's very easy to make profit in a trending market. It's the best time to be open or to have open long exposure, and that's exactly what we've done. If we make our way through our list, which is something that I won't do at this particular moment, the majority, I'd say 9 out of 12 shares have made their move. There's only 3 shares that come to mind after doing the Pivot Point Pro analysis class that is still yet to move, and that is, of course, opening up potential trades for the upcoming 5 trading sessions. However, defensively, or looking at this from a defensive mindset, it's all about exiting those positions at targets, or at least pulling those stops up to ensure adequate profit and to capitalize again and execute on this most recent bullish advancement. If there's one final piece that I can really say to you right now, it's just to really suggest that, look, this market can continue indefinitely, and it can continue indefinitely for a prolonged period of time. It's not until we get those definitive signals that the trend's reversed, i.e. that we start establishing certain chart patterns, candlestick patterns, we start breaking down below certain key structural key holds, that we'll start looking at this market in a different perspective. But what we can do right now, and really one piece of wisdom that I can really impart on you for the better, and again, it's up to you whether or not you want to explore this, but what I would suggest for you to do right now is to grab a pen, a piece of paper, and to jot this down and to think about it and to sit on it and watch this signal play out. Because in terms of trends, again, it's very hard to actually forecast the top. In fact, no one can really do that. But what we can do is really get out close to the top at any particular time frame. What I suggest you do is to write down the ADX as a technical indicator, to follow the ADX. And what I want you to do is to write down the date when this ADX definitively turns down. This is obviously going to correspond with a bearish candlestick, which will inevitably lead us into a sideways move, which is what we've most recently seen across the 3 US markets. What we'll see is some form of a controlled, deeper pullback, which is going to be the next establishment of the next higher low. But if there was a sort of like a key or a cheat sheet right now at this particular moment of time where I could say, hey, this is something for you to look at, and some piece of wisdom or at least some knowledge that I could share with you, is that during the many years of market participation that I've been trading the market as a professional, and also the many years, decades if not, of back trading, so to speak, or conditioning myself to become a technical trader, the best indication that I've come across is the joint ADX signal with the CCI. When that ADX signal turns down on the markets or an individual stock, or the CCI itself turns down and breaks above that positive 100 reading, that is the time again to be really diligent in tightening up your stops and locking in that profit. Until that happens, we're assuming that this is going to continue. We've got some really nice candlestick and also chart short-term formations which are presenting themselves, even though I'm not entirely certain that they are going to play out. But again, across the board, it's still elevated. The ADX still likes the move, so does the CCI. But again, across the board, when you see this definitively turn down, and again, I'm ending this discussion on the NASDAQ because you can see for yourself the ADX turning down, and this is in agreement with Thursday's candlestick. The CCI is still above that 100 line, which is fine. But when you start to see this across the board happen on the ADX, I would suggest, from a very kind place and from an honest place, to consider tightening stops or beginning to take active market trades or active market exposure off the table, and to become, or at least change your approach, your perspective to something which has been probably, I'm assuming, relatively aggressive in chasing these gains to the upside, participating and really reaping the rewards of this push higher, into more so of a wait and see type of approach to re-enter the market when the time is right. Now is not the time to be chasing the market. The market has moved. It's moved a very long way. It's now the mindset, it's now the approach to be looking at this defensively and thinking about how am I going to start taking, or at least selling some of my positions, whether or not it's entirely at once, which is not what I suggest, but to start taking them off layer by layer, piece by piece, percentage by percentage, to where you feel comfortable, as in you've locked in the most amount of profit or return on this most recent wave higher, which the market has blessed us with for the beginning of 2017. It has been an absolutely tremendous start to 2017. I wish you all the best for the week upcoming, but again, I think it's food for thought, and I'm happy to sit down and to share this with you because I think it's very pertinent and also very applicable to the current market. All right, so all the best, everyone. It's James signing off on behalf of Pivot Point Trading. I'll see you in due course. Goodbye.